Cool. Well, I think we can get started, but I'm super excited to host our first sort of Jeeves webinar. The idea here is for us to sort of have more of these conversations with experts in their fields and get sort of more all-star, rock star people to come and share sort of their views, whether it's founders, operators, investors. And I'm joined today with sort of four really amazing people who are all sort of global investors in different regions to talk about sort of the market happenings and what they're seeing from the investor perspective, which can help inform sort of hopefully what other startups are doing, what you should be doing, what you should be thinking about, and thinking about this from the investor perspective. So I'm really excited to give you guys a quick background on everyone here on the show, and then would love to sort of get started with questions and get into the nitty gritty. And then I know there's a lot of questions submitted by a lot of the participants. We'll get to some of that at the end of sort of this webinar. But if there's anything else that, sort of burning questions that come up, I know there's a Q&A section as well here, so we can take some of those questions as well. So hopefully we can have sort of a really active discussion. The idea again here is for us to really sort of bring together sort of the investor perspective and share as many insights as we can and be as transparent as possible, so that, as people are operating in sort of a lot of these uncertain times, we can sort of hopefully have a lot of very transparent feedback. Just as a quick reminder, and I'll just introduce myself first, but my name is Matt. I'm originally from France. I've been in the States about 10 years. Spent the last 4 years as an investor at Andreessen Horowitz, did late stage investment.
Oops. Not just me.
No. James, you want to give his introduction for him?
Yeah, Matt started his career as a late-stage investor in Andreessen Horowitz before spending a bunch of time with Fintech companies. He led an early round in Jeeves, where he fell in love with the company and became the head of growth just over a year ago. That's how we met, and he is happy to host this webinar when his internet comes back. I am a general partner at CRV, which is an early stage venture capital firm based in the Bay Area. I lead pre-seed through B investing, from pre-idea to scaling revenues. I led the Series B of Jeeves, and excited to be here today.
Hi everyone, I'm Adriana. I'm originally from Ecuador, so you have a pretty international crowd here today. I'm at Clock Tower Ventures. We're a fintech-only VC based here in Los Angeles. We also invest pre-seed to Series B primarily. And we participated in the Series A of Jeeves with Matt and the Series B of Jeeves with James. So we're very fond of the company and very excited about the prospects of startups in Latin America.
Go ahead, Akash.
Hi everyone, great to be here. I'm Akash. I'm an investor at Early Bird. We're one of Europe's longest standing funds. We've been around for 25 years. We do pre-seed to Series A, and I mostly cover the UK for Early Bird, and as well as that, look at fintech across the continent. Super excited to give a European perspective on the recent market developments and share some thoughts on relevant thoughts for founders.
And I'll go last. I'm Matt Cohen, founder and managing partner of Ripple Ventures. We're an early stage venture fund based in Toronto, Canada. We invest across Canada and the US, but our home is Toronto, so we invest a lot in the Canadian ecosystem. And we focus on B2B enterprise SaaS, developer tools, and Web3 out of our third fund that we're investing out of now.
Cool, I'm back. The hotel Wi-Fi is undefeated, but I'm back. So thank you all for joining us. And yeah, really excited to sort of hear this sort of global perspective. But maybe my first question, we can kind of go round robin, and curious to hear a lot of the sort of market specifics of where you guys are operating. But, sort of 6 months ago, Tiger was doing a round a day, valuations were sky high, raising money was, sort of a free for all. Public market valuations were all-time highs and growing. Fast forward 6 months later, we've got a first quarter of negative growth, as in the US economy. You've got inflation that's at 8%, but probably actually higher. The fundraising market is a little bit slowed down. And, we started to see some of like startup layoffs and even companies starting to blow up. So complete shift, I think, in a lot of mindsets that we're seeing, but curious to see sort of what you guys think sort of triggered a lot of that and what you guys are seeing in sort of different regions. Maybe we could start with Matt Cohen. I know you wrote a really interesting sort of letter to your sort of LPs recently, but maybe curious to hear your thoughts on what you're seeing sort of in Canada, the US, especially where you're investing, and sort of hearing a little bit more about what your thoughts are on that shift in the last sort of 6 months.
Yeah, so I sent out a letter. It felt like, a decade ago, but it was only 2 years ago to the day almost that I sent a letter to our LPs at the beginning of COVID in March or May of 2020, telling them that, this is not a time to panic, and this is a time for us to see the acceleration adoption of technology and cloud-based solutions. And we ended up being, right in that scenario, but we didn't see how fast it was going to accelerate. Canada is always slow to react on the upside, and we're also very slow to react on the downside. And that's just part of our DNA. And if you think about the ways that we typically fund our businesses, we have a lot of government support, we have a lot of financial institution support. And so even in the last global financial crisis with the housing collapse, Canada was pretty insulated from the rest of the global economy because we had such stringent investment criteria for loans and things like that. So 6 months ago, we were breaking records, just like, every other sort of startup ecosystem was. So we had broken records, from the last 4 quarters, even Q1 of this year, we broke records. We still pale in comparison to the US market. We're about 5% of the US market, but we were doing, $14 billion plus in deals across 720 deals in Canada. Now, a majority of that dollars were in the later stage, companies like Trulio and Wealthsimple and some public companies that went public, you have Applyboard and things like that. But we were never really caught up until the very end of sort of 2021 with the Tiger phenomenon. I'd say we started seeing a lot of those deals come to fruition in Q3, Q4. And then everything just suddenly changed in Q1 of this year. So as I say, we sit here today with a little bit of a pause in reaction to what's happening, but we never really got stuck in the upward cycle. And I think on the downward cycle, we're also not going to be as heavily punished, but we are seeing a lot of companies look at alternative financing options, which I'm sure we'll get into.
Cool. James, what are you seeing in sort of the US? Are you seeing something similar to Matt? And you guys look at stuff sort of at the later stage as well.
Yeah.
B plus.
Yeah, we look at
what are you seeing there?
All across it and also every region. Which I think meant that we all got caught up in the craziness, in good and bad ways, right? Like, it's very easy to think you're really good at your job when Tiger is marking you up every 3 months, which is like not exactly how fundamentals are created and not exactly how long-term foundational companies are created. This is probably a good thing. If you invest it, it's not probably, it is definitely a good thing. Unit economics akin to early days of Uber, when everything was negative gross profit, is not good for a startup ecosystem. It creates bad company values, it creates bad activities, and thus over time, when cost of capital goes up, the companies collapse. Like, we saw this in 2000, we saw this with a bunch of the ride sharing companies outside of Uber and Lyft. And so this is a good thing. It is not a good thing if you are a very late stage growth company, because what was the public crossover funds trying to give you money, now they could buy, they could buy Coinbase at 1 times future earnings. They should probably do that instead of buy you at 100 times current earnings. And so what we're seeing is the late stage market, especially the crossovers, drying up. At the earliest stages of the seed, there's basically no change. People are still doing deals. That's still happening. At the A and B, there's like a pause, basically. Insiders are doing rounds. So if you have strong insiders, that's happening because you know the company, you have a good relationship with the founder, you can basically come up with an agreement. Otherwise, no one knows how to price things. And so, because we don't know where the bottom is, Matt, you can say that you can fall 10% a day forever, and like you can. And so no one knows where the bottom is and no one knows where you should actually price these things. Having said that, and I'm sure we'll talk about this, like there is a lot of dry powder. It will open again. Like we as a firm are still open for business and active and have made investments, but we're just not making investments at 200 times forward ARR of a number that you may or may not hit because the cost of capital is now 3x what it was 6 months ago.
Yep. Cool. Adriana, last year was like one of the best years for LATAM generally, right? Like so many unicorns sort of newly minted, a lot of capital flowing into the region, obviously as well, sort of what are you seeing right now in sort of those regions and those countries with sort of the fundraising environment for startups?
Yeah, so I guess LATAM, it's a different story than the other regions because prior to 2019, it was totally overlooked. It was like just like flat 1 to 2 billion allocations in venture capital across the whole region. And I think there is a before and after with the original 5 billion committed by SoftBank in 2019 that started to have some tailwinds. And as Matt said, COVID-19 was a pretty important catalyst in demonetization, but also sort of the desire of global VCs to just deploy as much as they can and take advantage of this market craze infiltrated Latin America in a way that I think was starting to not look healthy. And there we land with 2021 at astounding numbers of venture capital flowing into the region and prices matching US prices at the seed through growth in a region that does not necessarily have the same risk reward aspects yet and does not have the same exits and precedents, right? So it got scary. Like it's interesting to see. It used to be roughly like a 50% discount to US valuations to invest in original seed investments in LATAM. And now they ended up being higher. 2022 has been way slower for the reasons articulated by Matt and James, but I think it's a healthy thing for the region. It's healthy that investors start to like step back and hopefully think through fundamentals again and understand that you can't price the same company everywhere with the same price. That's one thing. And then the other thing that I do worry about for this year is the amount of sort of tourist investors that probably came last year that were riding the wave of the heat of this is the next place to invest in, and very FOMO driven attitudes around just backing whatever you're able to back in the region, pricing up things. Now that music is over. So I do worry what's gonna happen with some startups that took some sort of extraordinary caps and some investors that are not thinking of being there for the long run, but sort of were there for the heat of the moment and like what's gonna happen to those investments. At the same time, as James said, there's a lot of dry powder left across VCs, across stages. And so it shouldn't be the end, but I do think it will shake out who really wants to spend time there for the next 5 years, who was just exploring and what were the right prices of entry and what were the really, really like crazy things to have done down there. So it'll be an interesting year, to say the least.
Yeah. Cool. And Akash, like other side of the pond, what are we seeing sort of in the UK and Europe? Is there sort of a similar lag than in Canada that Matt mentioned, or what are you guys sort of seeing in Europe and sort of the UK around sort of startup investments right now?
Yeah, I think that is the case. There is a lag, the kind of lag that Matt talked about. So the Q1 numbers were actually, obviously, a lot of rounds closed in November and December and only got announced in Jan and Feb. And Q2 numbers will be a lot more revealing. And as for leading indicators of whether there's been a slowdown, I think it's mostly at the growth stages, which everyone's touched on. And we're seeing all of that capital and all these multi-stage investors just reallocate towards early stage. And a lot of growth investors just sort of licking their wounds at the prices they paid in the last 2 years for these assets. But I think Europe has also got a lot of good secular tailwinds going for it, which have probably propelled it to this point where that could be a partial reason for the lag. And that includes things like in the last 5 to 7 years, European ventures still outperformed US venture. You've had more funds being raised than ever in Europe. And ultimately, some of the policy making has been quite strong as well. So in France, the government's been a very active supporter of the ecosystem. They want to champion loads of decacorn companies. So all of this is to say that there will probably be a correction to come. But it's just that in Europe, there's been a lot of momentum in a positive direction. And the macro environment, though, is definitely as bad here as it is elsewhere. Interest rate rises, inflation concerns. We're seeing 8% inflation in the UK. So the ecosystem isn't immune to that. And I think we're just waiting for a few months until some of that starts to be reflected in early stage prices. So seed is still very robust. Series A is still very robust. And the other thing is a lot of cross-border investment. So US investors setting up offices in Europe. We have even investment from Asia, from the Middle East, a lot of sovereign wealth funds. So all of that influx of capital has to be deployed somewhere, let alone all the new GPs in Europe. And that's probably why the lag is a bit longer. And we're still, the headwinds are quite considerable. And I think the advice that we're giving our founders is that they should be very thoughtful about runway. I'm sure we'll discuss some more practical tips we can give to companies. But it was quite stark that in the recent numbers that Europe has still been probably the only continent that hasn't seen a massive downturn or hasn't seen a downturn in valuations or funding. But I do think it's not immune to it, and it's just a case of time. And most of the funds here are doing as early as pre-seed now. And so the growth guys are just going to probably slow down slightly, and the early stage teams are going to be a lot more active.
Something that was very interesting that was happening over the last 2 years was people were talking about absolute valuations instead of multiples. It's like, I can pay $100 million or I can pay $500 million because there are $10 billion companies or there are $20 billion companies. And that has stopped in my peer set in the US, in that it's not like this company is pre-product, we're going to value it $100 million because who cares? There are lots of $10 billion companies out of there in the universe. That has been very interesting to watch that stop in real time.
Yeah, maybe just like following up to that, James, like, are you, the way that you're sounds like, you're still looking at investments, sounds like valuations are down, the velocity of deals are down, but are you shifting your mindset in how you do diligence? Like certain deals that you might have done 6 months ago, you're not doing them anymore, or are you looking at certain more metrics more carefully? Like, is there anything that sort of changed in sort of your both sourcing and maybe diligence process within the last few months? And do you expect that to continue to sort of change and iterate over the next sort of, few months as well?
Yeah, there was a lot of, I'll call speed diligence over the last 2 years.
24-hour diligence, you mean?
Yeah, 24-hour diligence. And we would often pass. We were like, we can't do this. And someone would do it. And you can argue how much diligence people were doing. And that was a shame. Right? You would see what we thought were high quality businesses and amazing founders in great markets. And you're like, I just can't do this. And so I think that's good, because for us, we may do more things in that sense. Having said that, hopefully we'll now have more time to do diligence. But for the founders on the call, it should be two ways, because the number of, and actually none of the people on this call, because I actually like everyone on this call, but there are a number of VCs who are bad actors. And the same is true of any category, the number of founders who are bad actors. But you can actually do two-way diligence now. And if you truly believe you're building an enduring company, and that's going to take 5 to 7 years because the laws of gravity still exist, like, you should diligence both sides of it. And that's now going to happen again just because there's less FOMO, which is really only a good thing, because you should want to know who you're partnering with if you're going to work with them like for a long time.
Yeah. So two-way diligence, I guess, like, Adriana, like in terms of diligence and sourcing, like, are you changing anything to your methods? Is there anything that you're looking sort of more closely at? I know you guys are also working on sort of an opportunity fund and investing at later stages. Like, any sort of process changes that you guys are implementing?
So for everyone's context, I think we're the only fund here, but we never lead rounds. We're only co-investors, always participate in syndicates and collaborate with other investors in the diligence work. And it's been interesting for us from this angle to see the huge array of how lead investors are making decisions. And there are some that have stayed pretty disciplined throughout this all and have passed a lot of things, and they're probably very glad they passed at this point. It varies so much at the seed and B and growth. Like at the seed, there's only so much you can do. Today, yesterday, a year from now, there's so many unknowns. And in the end, you're backing people and you're trusting decision makers to make enough right decisions to deliver a net positive outcome. And so at that degree, there's that hasn't changed, to be honest. That hasn't, like the one thing that changed was when we went to Zoom world and we had to build comfort investing in people that we had never met in person. And once we broke that barrier, we stayed true to every other criteria we had around reference checking and like our own rubric and frameworks of high quality founders, but that's pretty much remained the same. At the growth stage, it is interesting. We do have a newly minted opportunity fund, which is primarily for dedicated portfolio companies. And there's a handful of investments that we did right off the gates that I think if they were done like 6 or 7 months later, would probably repriced. But we closed on some of these rounds as the market meltdown started, but we have had so much trust and such an unfair advantage in getting to know these management teams for such a long period of time that you can't change that for 2 weeks of diligence. And so I do think in some of these cases, we actually hit an angle where some people were running away from some of these companies, and we were like, actually, no, we think it's a great time to enter because we trust this team, we understand its fundamentals, we've seen the execution, and that's like very long and durable diligence experience to have. So we've I guess to answer your question, we've leveraged existing relationships and companies that we know best as the right person, the right opportunities. We've actually set out of most Series Bs at this point. We haven't done any this year. And I hope that changes, but those are like proving to be the hardest rounds to get a hold of right now. There's still a bit of a dislocation in terms of founder expectations of value and VC's expectations of value. And that it's harder to narrow the gap than at the growth where it's like very evidently slow, like stopped, and at the seed where it hasn't really like repriced entirely. I mean, it has to a certain degree, but to like normal levels, not to what feels like cheap anyways.
Yeah. Matt, maybe like similar question, and maybe throwing in sort of another angle as well, which is like LPs, right? Like, are your LP, like, is the LP sentiment like, hey, we should maybe stop funding venture, or like our allocations are going to be half, or, you know, they're calling you every day, like, hey, what's going on with my portfolio? Like, what are you sort of seeing from your LPs? And, you know, how do you think that sort of changed? And yeah, curious to hear your thoughts there.
Yeah, for sure. I mean, we're very open and transparent with a lot of our companies and a lot of our LPs. So they're constantly up to date on what's going on, and we like it that way. And I would say, like, for all the founders out there listening, like this ecosystem, and the definition of an ecosystem is everyone has its role and everybody knows what their roles are and they all kind of feed off each other, is the LPs are extremely vital to this ecosystem we live in venture. And so to sort of put your head in the sand and say, well, I don't really care who the LPs of whose venture fund are, I'm just going to build my business, is not really the right way. You have to think about the opportunity cost available for LPs right now. Just as James said, like if an LP is overweight in venture and then they see Coinbase trading at 2 times earnings with 50% in cash, that's an opportunity cost they have to make as they allocate their resources accordingly. And so everything is connected right now. The LPs are definitely overweight. They're telling people to slow down. You know, the funds that we've seen announced have been raised in the last year or so, that's the final closing. So remember, when you see a final closing announcement of a fund raising 100 or 500 million, they've been investing for the last year out of that fund. It's just the final close was announced, you know, let's say a quarter ago. And so you should be asking as a founder, first off, like, where are you at your fund cycle? Should you, you know, be the last check-in for that fund, or are you at the early stage of investing out of that fund? That's really important. Well, who are your LPs? What are their abilities to do co-investments, direct investments, things like that? Our third fund, luckily, is backed by one of Canada's largest financial institutions who wants to be supportive for the next 10, 20 years and wants to be writing direct investment checks as well. So that's really important for us to share with our founders. And we tell them that a lot. The other thing to understand is, as a founder, the LPs that people have in their makeup, are they, family offices, endowments, pensions, fund of funds, things like that, because all of those different groups have different expected return profiles. And you need to understand whether or not that aligns with what you're trying to achieve at your company as well. So LPs are definitely asking questions. They're definitely overweight venture, and especially like emerging managers, early stage. It's the Charles Rivers, the CRVs that have been around for 15 plus years. They've been through these cycles before. And so their LPs are quite, comfortable with them withstanding it. But some of the earlier funds and earlier stage emerging managers like ourselves, we have to really prove our worth in these kinds of markets. And by over communicating is the way that we're trying to do it on both the founder side and the LP side.
I would love to talk about that. I don't think anyone on this call is going to have this issue, but if you think back to March 20 or go to 2008, 2000, and people were making capital calls, sometimes the capital didn't come. And what that means for you as founders is that a VC who is not someone around this table who has a track record, but an early VC, and they call capital, it just may not come for you. That's not going to happen here. And I don't think it's going to happen really yet. But there is a universe where funds who think they have money actually don't have money because it depends on who their LPs are.
I remember some people that were afraid to ask for capital. They were like, actually, we don't want to do capital calls right now. We don't want to ask for money from our specific LPs because we don't think it's a great time for them to ask for money.
I'm an LP in a bunch of first-time funds who maybe they're previous operators or whatever they were, and they're like, I don't know if I can ask for money for the investments I've committed to. I'm like, of course you should, because you've backed the founders, but it's they're very scared because of what's going on, and so that point about who their LPs are, which is something most founders basically never talk about, is actually really important. Like who they are, where the money's coming from, and are they going to be around?
Yeah, and where are you in your capital call cycle too, right? Do you have a capital call line? Larger funds and ourselves have capital call lines that they can use to spread out between tough times in the markets. Nobody wants to make a capital call this week, that's for sure.
For those on the call, that means a debt line that they can just call, and so we can get money from insert name a big bank instead of LP.
But I do want to advise that the way a founder should handle this conversation with a VC, you should be very careful. It can come off as weird if you're straight up asking, name your LPs, name your capital call cycles, name where you are, how much money you have in your bank account, so there's some subtleties to asking these questions, and you also need to understand it's stressful times across the board. So, just make sure you get this information, but make sure it doesn't feel like you're also grilling.
How have you seen people ask that in a really sort of thoughtful and sort of obviously non-aggressive, but sort of very thoughtful and productive way? Is there anything that you guys can sort of recommend sort of founders and people raising money who are talking to VCs right now, or will talk to VCs? How can you ask a VC who their LPs are, but in sort of the best way?
I think sometimes a VC's value add and purpose is tightly related to who their LPs are. Not always, but sometimes. And so you can ask more about, so what's the history of your fund? How long have you been around for? Which fund are you on? How many investments have you made out of this fund? Those are it's almost the same questions that they are asking you as a founder. So there's nothing wrong with that. And then from a value perspective, are some of your LPs interested in participating in the regs, or what is your level of involvement with your LPs? And maybe that can lead to a more subtle way of having this conversation rather than being straightforward about a questionnaire of, I think.
Yeah.
Akash, for the people in Europe, do they ask the same thing?
Yeah. It's not come up as much, but I guess the sentiment in Europe among LPs is that the new managers in particular are not really where they're looking to deploy at the moment. They're looking to double down on their existing relationships. And that's the profile of VC or nano fund or first time fund that you probably would ask that question of more, the ones that have a long-standing track record as you said, that includes everyone on this call, but that is no longer the majority. There's a lot of new funds that have been raised in the last few years and new firms. It's those ones that might have difficulties also raising their second fund, especially when they can't show DPI yet. And that's another bigger issue in Europe, which is exits. And in 2022, already in Q1, the reduction on Q1 in 2021 is really massive. That's always been an issue, and especially for growth investors. But when it comes to showing performance, European LPs are already quite conservative, and they want to see DPI is actual money out distributions for the founders on the call. And that's always been notoriously difficult for the 2017, the vintage after 2017 to be able to show. And so far, those funds are the ones that I think you should be asking those questions of. Some of these might be leading you around, sometimes they might be followers, and that might not therefore be as much of an issue when you're doing inside rounds. I think your longer standing VCs will be able to do that. But if you're looking to speak to some of these new funds who are looking to lead rounds, then I think it's very valid to ask those questions.
Yep. Maybe just a question, just to shift gears a little bit, like sort of what are you guys sort of recommending to your founders, right? Like board meetings right now, is it tighten the burn up, watch your cash expenses? Is it, last year was obviously like grow as fast as you can, 5x plus was best in class. Where are sort of those conversations happening sort of in the boardroom with sort of your founders, and sort of what are you guys recommending there? Especially as it relates to, maybe the second part of this would be like, as it relates to runway, like, hey, is debt financing interesting? Is alternative financing interesting? I know that's been asked in the comments a couple of times as well. Like, is that something where you guys are sort of recommending to your founders? Like, just maybe bring us to some of those conversations that you've had sort of in the last few weeks and what you guys have sort of been talking about.
So we're on the board of almost every one of our companies, 25 or so. We led or co-led the deals at the earliest stage. So we're on the board since the beginning. And I'd say in the early days, at the sort of pre-seed seed, it was like, 12 months was fine. 12 months runway was totally adequate. Nothing more than that, because you're going to go out and raise your seed or, your early Series A round within that time period. From seed to Series A, though, and Series A and beyond, the 12 to 18 month window has definitely shifted to 24 months. I've had 2 board meetings this week, and everything is like 24 months. That's really important. The other thing that's important is pipeline coverage ratio is starting to be really looked at. So if people are like, yeah, we're going to grow 2x this year, but their pipeline is only showing 2x coverage. And what I mean by that is if you're going to go to 3 million and you only have, 5 million in pipeline, you're not an adequate pipeline for you to actually hit that target. And so everyone's like, pipeline is really important for us to judge how close you are to hitting those targets, because that's what people are going to value on. So 3x is sort of the minimum target people want to see right now. And then, cutting extra burn that's not really delivering on ROI. So, the first things to get cut are typically like marketing, those like very throwing spaghetti at a wall and seeing what sticks types of expenses are being cut heavily. I'd say the good thing for a lot of our companies are they are cost savers for a lot of their customers. So a lot of them build in, like, we have a lot of enterprise SaaS workflow automation, pen to paper transition businesses. And so if a recession does come in Q2 and Q3, and a lot of their enterprise customers are looking to save money, they aren't usually the first solution they cut. It's actually the human capital that is the most expensive that they're trying to cut. So we're trying to get them to think about like the messaging and changing the way that they are positioning themselves if that recession does come. But the numbers are absolutely going to default alive. And how do you go into a 24-month runway scenario if you can't raise? Because the raises happening now are, flat is the new up if you're doing like an insider round. And then last thing on the debt side, absolutely. If you have anything with SVB or terms or anything, you pull that down. Even if you don't need it, you pull down, 1 or 2 million of the 3 to 5 you have or whatever, and start using it right now, just so you have it, because we are seeing renegotiations on term sheets that have been signed from the debt providers.
Yeah.
Or you go to Jeeves.
Yes.
And we go to Jeeves. Yes.
Exactly.
In March 2020, I remember that IT budgets, depending on who you sell to, IT budgets froze instantly. If you were an IT buyer at any major company, you couldn't sign up on a new transaction. And so I won't repeat what Matt just said, but what we're telling our companies to do is go line by line through every one of your pipeline companies. Say, who is the champion? Where are you in the cycle? Who needs to get sign off? How real is this? And be really intellectually honest about the pipeline. Because if I remember like any of the last cycles when this happens, like the whole thing comes to a halt. People get fired, you're not spending money on new software, or anything like that. And so that you got to be really honest about. 24 months is definitely what we're recommending to people. If you look at history, basically every major recession that we've ever talked about lasts about 2 years. So and so this could last longer, this could last shorter, but it's probably gonna last 2 years.
Adriana, what are you telling your founders?
Yeah, especially, well, at the earlier stages is same, just try to not go too crazy right now. At the growth, very similar to we heard from Matt and James, 24-month runway. And the funny thing is that a lot of the flat rounds that are being raised right now still feel sort of overpriced to traction, or feel at least adequately priced. And so it's not a terrible scenario for a lot of founders because they didn't take enough dilution last time around. And in a certain way, that was sort of an insurance policy. Right now, they're just taking some more, making sure that they have enough of what they need. But definitely encouraging people to see a scenario where the next 12 months are not going to be, they can just tap and get money, especially from net new investors starting Series B and above.
Has anyone seen structure come back yet? And by that means, I mean different preference stacks or anything like that.
We've seen like 2 occasions.
Verbalized, not in paper though.
We've seen it in paper, like specifically some companies that were ready to raise only equity, and instead of repricing, they basically got structured.
It's interesting, Akash, that you're shaking your head because Europe, not that long ago, was really famous for 2-3x liquidation preference structures on top of equity rounds.
It's probably happening, but I haven't seen it yet. But I've heard of murmurs that some predatory stuff is beginning to happen.
I think it's happening at the growth stage for sure. It has to. Ratchets and 2-3x liquidations.
March 20, a very high profile San Francisco company that raised from a lot of people, a lot of really famous funds, freaked out. Like March 20 totally freaked out and raised a party round with 2.5x liquidation structure. Like instantly at March 20, it raised like $100 million, 2.5x liquidation preference. And it was wild because if they raised it a month later, they probably would have been 2x valuation and common and whatever. And these are really experienced founders, sold their last company for over $1 billion. It was absolutely crazy. And so I'm waiting for that moment when I was like, is this going to be really bad? Because that felt real.
I guess just to add to some of the points that were made before and echo everything that everyone said in advice to companies. Of course, there's going to be a lot of consolidation, and I think it'll be tempting for a lot of companies to be acquisitive at this time, especially in the next few months, as some companies definitely go through a distress phase. But I think what we're saying is that the focus should be on growth and integration where they can, and only really consider acquisitions if they can actually raise the funding for it, and not at the cost of the runway that the company has. And at some point that would come into that conversation as well, to be very, very focused on your top and most profitable customers, reduce the hiring budget and sort of begin to lean out low performers. Sales, try to reduce high fixed salaries in favor of variable commission-based salaries. And yeah, just perform some analyses and cover negative cases where you could have cash flow issues because your top line isn't growing as fast as you'd expect. And to this point on IT spend, it's definitely gonna be affected. your account execs aren't going to hit their targets. And if you don't manage your burn, then and you still assume certain projections will hold, then you'll be in a tricky cash flow position pretty quickly. And then even positioning cost savings as you go to market instead of productivity improvements, that would be a viable way to go about it in the next few months, and who knows how long after.
Akash, are you telling your, like, if your founders are asking you like, hey, do I focus on like, sort of these new initiatives to grow sort of that 3-4x this year, or do I hunker down and fix my margins or my, sort of unit economics? Like, where's sort of your head around sort of those discussions, and like, where are you telling them to sort of prioritize a lot of their efforts there?
Ideally both, but I think I mean, another way I've tried to segment this is there's been a lot of focus on building out the org and not enough on finding product market fit. I mean, just speaking of very, very early stage, it's been tempting with especially a lot of downstream investors coming earlier to implement the mental model of sort of you sort of get a flywheel going and you need to get mind share and then you win a category. And this playbook does work. I think it also in certain favorable market environments, it's very effective. But you can have like a house resting on a very weak foundation where the company's kind of done that at the cost of actually speaking to customers, validating the need for the product, and then totally owning a vertical and then expanding into other verticals. And instead of being kind of trying to do all these things at once and then really failing to really get sticky customers that are happy and then parlaying that into other verticals. So that's like the more general advice that I'm trying to dispense. But definitely where the growth, I would rather that they focus on unit economics than top line growth at this point. Of course, it'd be nice if you can balance those two things in parallel. But if there was a slight bias, it'd be towards the former.
Yeah,
it's worth flagging that depends a little on the stage, but also the business model, right? And like not all business models are created equal, and there's gonna be a flight to quality towards the more capital light, easy to scale, and less towards the like core lending businesses or like just like very capital intensive to scale companies. And so depending on which business model you have, the priorities will probably like change a little bit. And just keep in mind.
Yeah, and like I know, like capital. This is a really interesting question too. Like capital-intensive business models, right? Like at some point they were loved, then they were kind of hated. When raising capital is harder, like is that a place where sort of you're looking at the opportunity set of new investments as well? Like even early on at the seed, right, where still deals are happening, valuations are still relatively high because at that point it's still sort of sort of an option on the founders really, really early on. Like, is there business models that you get more excited about today, right, that you didn't sort of 6 months ago, or not really?
I don't think there's any that I get more excited about, but there's certainly some that I get less excited about.
Okay.
Yeah, we've like, I think specifically like just all sorts of lending, especially high risk lending. As fintech investors, we've done a lot. And right now, it's not like we wouldn't do it, but we would think a lot hard about doing one of those. And it's a little psychological trick because what are you investing right now at the seed? And there's still a cycle that those companies have to go through that is not whatever's going on today in the public markets. But it does affect, I think, investor psyche and like makes you rethink a little bit of like what could happen and makes it harder to make the decision, as we'll see as a B2B software company.
I'd say for us, the things that get us excited are companies that can go horizontal SaaS once they've tackled one market, kind of the way like Jeeves is doing. I'd say like if you can lock in on one type of like recurring SaaS business model. So one of our businesses would be like Rose Rocket. They've got like the traditional software business they sell to the logistics industry. And now they're expanding into a much broader category of like, payments, working capital, insurance, all these different types of businesses that you can wrap around, which then multiply the TAM, 10x. Those are really exciting businesses for us to be looking at. They've always been exciting, but I think now especially with like the defensibility of a SaaS business still there, and the ability to build a flywheel around that. With all the different, fintech and API integrations and low code infrastructure plays for you to spin up all those different types of product lines. Before, when Uber had to do it, they had to build it themselves. They had to invest in it. They had to build the R&D teams first and the product teams for each different segment of the markets they were trying to tackle. I think now, a decade or more later, it's really easy to spin up those different business environments. And that's really exciting if you have a very core SaaS business at the heart of it.
Yep.
We do love payments companies. That's one thing we always prefer, and like we still love. And even if you enter a high inflationary environment, that's like higher volumes for payments effectively. So payments all the way, and payments with software.
I think we're
super helpful. James, I know Matt started talking a little bit about sort of the debt world, and I'd like to maybe spend, because we talked a lot about the equity markets, but sort of the debt world is really, really fascinating, whether it's sort of traditional venture debt, right, with the SVBs of the world. There's a lot of alternative financing coming as well into the market, and providing sort of, capital to those founders, extending their runway. Like, are those areas that you get excited about in terms of, sort of recommending to your companies? Do you think that's like a viable source and a sort of way to sort of weather the storm or extend runway in this sort of time? Like, how are you sort of approaching that world, and sort of the other side of the equity sort of equation?
It's actually pretty interesting because, in a universe like today, it's not exactly self-serving to be like, take debt where I could do an insider round at a lower price. Having said that, you should absolutely be taking debt if you can get access to it easily. And the problem with traditional debt is you need a real finance team, and you have to be aware of covenants, and you have to be aware of all the different structures that come with all the debt. There are other providers, Jeeves, Matt, yourself included, that make this easier today. I would encourage people not to take too much debt, because if you don't know what you're doing, the covenants and costs and issues that come with that, especially if an equity round or free cash flow is not coming anytime soon, that can be pretty difficult for a business. But and I'm trying to think how many board meetings I've had now since this whole shit has started happened, maybe like 6 or 7. Pretty much we've talked about debt in every one. If you have it, draw it. If you don't have it, figure out how to get it. But you've got a lot of other stuff going on. And so get it from a place that feels cost effective and less friction if you can. Like I was talking to a CFO yesterday, like, don't spend a month with SVB who are going to charge you a lot of money and be very difficult on drawing the line and all the things, just because now they're in a point of leverage. Just don't do that. Either take a quick insider round from me, take $2-3 million, or take something from people like Jeeves or others who have a similar product.
Yeah, Akash, our debt. How do you feel about debt, sort of traditionally, sort of for some of your companies, and especially sort of in these times? Like, is this sort of a place where you're telling them to go spend time, whether it's alternative financing or sort of traditional financing from lenders? Like, is that something that you guys are having as conversations, and sort of what's your point of view, especially during these times?
Yeah, I echo everything James said in terms of the traditional providers being very, very slow to underwrite. You go through heavy DD. In the end, you're getting as good a product much faster with a lot of the new players that have emerged. And Europe's quite crowded and probably has parity in terms of offerings as the US does. Obviously, we're going through an interest rate cycle now, so it'll be interesting to see from an investor hat how some of these credit models work will fare. But from a company standpoint, I think if the company doesn't desperately need to raise, but still could inject some of that capital to pretty effective targets, then that is definitely not a bad idea. And we get a lot of inbound from a lot of folks, the Uncaps of the world and others, and Cap Chasers of the world in Europe, who've previously started with simple products like revenue-based financing, but have now realized there's a need for different flavors of this. And it's hard often to pick one. And I think to that point, Jeeves is quite a holistic product, and maybe it's a bit easier to convince portfolio companies to take a look at something like that than all the other providers who look fairly commoditized. But certainly think that if they can raise the debt for good reasons, and it's not just purely down to runway, but maybe they need a bit of time to go into their valuations. And so instead of raising equity, they could raise some debt. Then I think that's a really strong case for it.
Yeah. And I guess like it's also sort of to that point, like it's just, you know, if you're going to go set up a debt facility right now with like a lender and you haven't had that relationship or you haven't built that, and it takes 3-4 months and they're going to ask for even more warrants, right? It's a difficult conversation to have, or something to structure, where sort of easy, sort of quick revenue-based financing, or sort of these sort of more nimble players that can wire very quickly with very sort of low restrictions, like ends up being a really interesting alternative. Especially if, like, you know, James, like, I guess you would like to invest at a lower valuation, but like, you know, sort of down rounds, flat rounds are really, really hard, right? Obviously for startups, for founders to both take that money, for, you know, options to become out of the money. Like there's a lot more sort of downstream implications that, you know, sort of you might not always be ready for that yet. And, you know, you might want to think through those options, and, you know, obviously alternative financing can be sort of a middle ground there as you sort of, again, weigh your options, figure out sort of the right path forward, and get the plan for the year ahead. So super interesting. Adriana, how do you feel about debt? LATAM debt, you know, this is relatively, like, it was mostly equity, right? And got almost like more expensive than US equity. But debt markets in LATAM are even notoriously, I would say, harder than even Canada, the US, or in Europe. What's your sort of point of view there, especially as it relates to LATAM?
Yeah, it's definitely harder. It usually has much more stringent equity requirements and very, very high rates. Like, it's very hard to just lend money at reasonable interest if you're truly funding it on a deadline. And so, yeah, we need more players like these that are focusing on the region from a ground up perspective, and eventually being able to offer like much more attractive prices than US funds that are just looking to make EM sort of yields in these lines, or local funds that don't have the scale to fund startups nor the appetite to take that kind of risk in exchange for exponential returns.
Yeah. Cool. I know I want to take some couple questions from sort of the teams in the Q&A section. I know there's some questions that also have been submitted. I've tried to tackle a couple of those, but I guess like maybe one of the questions is like, how much of this are we seeing sort of parallels from like previous recessions, and like or sort of like, you know, market sort of, you know, black swan events or whatnot, and like how are we trying to at any point telling founders to continue being aggressive, like sort of go for that burn plan, that 10x plan that you sort of presented, you know, end of last year? Like, is there some of those conversations happening at all, or is it really sort of across the board, like hunker down, really get that to 24 months of runway? Curious if any thoughts there across the board that you guys are having.
Now, I'd say like from like my experience working, you know, on Wall Street during the last crisis, I wasn't working, you know, on my first company that I was building until 2012. But I think when we started that company, we went out with the mindset that we would never be able to raise capital at all. And that ability to kind of beg, borrow, and steal your way to kind of profitability allowed us to, you know, really have a viable business over the next 5 to 7 years, and eventually sell it to Yelp. And I think that's been ingrained in my DNA forever. So any founder that is starting a business now, if they go in with that mentality, it will last with them for a very long time, I think. And that's a really good way to lead an organization. As James says, it kind of reverberates across the culture of the organization. You know, we try to find founders that are humble, hungry, and leading with their head and not their heart. Sometimes when you lead with your heart in these kind of markets, you kind of ignore everything else around you. And we are in a extremely globalized and interconnected world. I mean, who would ever have thought that Ukraine-Russian war would, you know, impact the way that your creator tool company is being thought of by the markets? It's like fathomable to think that how connected our world is today, so that you need to be aware of your surroundings at all times. And so, prepare for the worst, but, plan for the best is sort of the way you have to think about building businesses today. And so we're telling founders, never let a good crisis go to waste, as Winston Churchill said. So never let a good recession go to waste if it does happen, but don't be foolish to think that you will not be impacted, because the decisions that, James' firm and everyone's making is not just about your company. It's about everything in their portfolio. It's about everything about their LPs. There's so many interconnected decisions that have to be made in order for you to get a check that you have to be aware of. So don't just sort of bury your head in the sand and think it's only about your business and your company at this moment in time.
Yep. Any other thoughts?
Just very briefly, I think there's still going to be others have said this as well, but eventually there will just be a separation of quality, of flight to quality, and the very good companies in the portfolio, we won't have to do as much handholding and firefighting. But for the others, it's just that what was once a capital abundant environment is obviously not going to be there, and so we'll just have to really be more proactive in helping some of those companies. But the very good companies will continue to get funded, still probably at exorbitant prices because of that supply-demand imbalance. So I just think there's going to be a separation of the cream of the crop and the rest. So it's not across the board. Hopefully we all have some good performing companies, and so it's just some of the other ones that will need a bit more hand-holding, a bit more support, where this advice is pushed a lot more.
Cool.
Yeah, the last thing I'll add about the parallel between this and previous crises, and we touched on a little bit about the M&A market, but you can remember that Microsoft bought LinkedIn for like not a lot of money relative to what it was worth at the time. And today Apple could buy Shopify without blinking an eye. And I'm not suggesting they're ever going to do that, but they could with the cash on hand. And there are lots of buyers out there who have big cash reserves. So if you think back to the last couple of years, M&A was happening with high price equity. Startups were buying other things, like, look at our equity, look how high it's priced, and they were buying companies that way. And, the Money Lion acquisition.
Where LinkedIn, Microsoft.
Yeah. Right.
Fire sale.
Complete
7 times sales.
Which was insane. And so that's going to happen. There's no way all this cash sits down where it is, and with inflation where there's just no way it doesn't.
Yeah.
And so for the founders on the call, the M&A market might actually open up more than it did in the past. So that's probably a good thing. But they've also may buy your competitors. That may happen too.
And I think, just adding to what James said, we have seen some founders already just take exits that were probably not the size of outcome that they expected, but they're exits nonetheless. So sometimes it's worth having this like philosophical or like self-reflection of like, would I rather have this like burning hand or just truly, try it out? And sometimes like there isn't a right answer, but maybe it is worth taking the M&A trade and having some sort of return for your efforts and not try to, depending on your competitive landscape and your current fundraising status and how the company is performing, I think it's worth considering the full spectrum of options rather than only going all the way for like the massive outcome and win, because maybe you might be left with none of that either.
Right. Cool. Well, this has been a really awesome conversation. Obviously, like really, really interesting to see the perspective from sort of the Canadian market, US market, LATAM, Europe, sort of what are the differences that you guys are seeing there, sort of some of the sort of learnings, where this conversation should be and what founders should do. So I think this has been really awesome. I've learned a ton now that I've sort of have been less in the day-to-day of the investing world, of how you guys are thinking about things. So this has been super, super insightful. I guess maybe like last question. Sorry?
We miss you in the investing world.
Yes. I guess maybe last question, which you guys are all going to hate, but I'm still going to ask you guys, which is like sort of prediction next 6 to 12 months. And I will all be wrong, I guess, but I may just curious to hear your thoughts. Like where sort of is the bottom is in your view, and when does it start getting better? Maybe like sort of rapid fire across the board. Matt, you want to start?
I mean, I hate to catch a falling knife. Nobody wants to put their neck out on the line to do that. But I will say that I feel very fortunate to be a pre-seed investor that has 10 years to actually deliver results and be able to show, companies building. So I'm still very bullish on the early stage. I do think this is going to be a time where a lot of generational wealth is created in markets like this, when you're not competing, for crazy valuations. Founders are really hungry, and the competition for talent is not as expensive as it once was a year ago. And you can actually get real people bought into your vision for fair prices to build for the next decade. I think that's a really exciting time. So trying to stay default alive for the next 6 to 12 months is your most important goal as a founder right now.
I love it.
Yeah, I would say remain as bullish as ever in Latin America. Like, it's important to keep in mind the fundamentals have not changed. The region, there's still a lot of stories behind it. What makes the region so attractive, and that hasn't changed. And what has changed is what's going on in the public markets. What has changed is investors' perspective. But there's still a booming population that needs financial services and all sorts of tech-enabled services, and that won't disappear. And so I think this is actually setting the stage for a healthy growth curve. And there's a lot of exciting stuff to see. I'm very much looking forward to our continuous commitment down there.
I agree with that. There's a lot going on in LATAM. We continue to do more there. Prediction, I guess, different to everyone else, is I think there's going to be one of the biggest M&A transactions of all time. I don't know who it's going to be, and I don't know who's going to buy it, but like akin to, and I'm not an investor really to this, but Amazon buying Snowflake, like something like that size, which would totally change the face of the market. I don't know who's going to do it, but I think that's going to be like fundamentally shift what's happening in the market when that does happen.
You heard it here first. You heard it here first.
Decided to actually say something, because like everyone's like, the market's going down, we're going to invest. Like, we're all good. We're all going to do that. It's our jobs.
Oh gosh.
Yeah, I don't have a good soundbite, to be honest. I'll have to echo what everyone said. I think the year will, for Europe, I think the momentum is still there for the year to not finish out that much lower on 2021 in terms of funding. And I just think that, as mentioned, the capital will concentrate at the very early stages, but would just echo that the last 2 years were the anomaly and not sort of the linear trend. And it's actually just somewhat of a normalization that was inevitable. And so some of those second order effects in terms of getting to know your investors really well, the types of investors you're taking on board, having to be focused on unit economics, these are all good things. And so there's kind of this sort of interpretation of all of this as being quite gloomy, but actually there's a lot of good things to take away from this. And good companies will always get funded. And so I think in the noise of it all, that message is maybe getting lost. So I think I'm sure everyone who's listening believes that they are one of those companies. And so I would just say that the fear and the FUD is a bit overblown. And so, yeah, just to keep that in mind.
Cool. I know people have to hop, but I really appreciate all of you guys' times and insights. It's been really, really awesome. I've learned a ton. I hope it's been helpful for people, and we'll have sort of more conversations as things continue to progress. So thank you so much, everyone, for joining, and thank you guys for joining the panel as well. Really appreciate it again.
Thanks for having me.
Thank you.
Bye.
Bye.